You know that feeling. When all the economic news is just swirling around, global events are constantly shifting, and you feel like you're trying to catch water in your hands.
Yeah, like you're drowning in information, but not really getting the clear picture.
Exactly. And that's precisely why we do this. Welcome to the deep dive. We focus in on specific sources to, well, bring some clarity and pull out the insights that really matter for you.
Think of us as your sense-making partners, really. We uh, sift through all that complexity, try to connect the dots, and highlight those moments so they give you a proper understanding of what's actually going on.
And today, our deep dive is into the FT Quarterly Equity Outlook May 2025 report.
Right. So this is a pretty recent quarterly analysis. It looks at the big trends shaping the global economy, but it also has a specific focus on the Indian market, particularly equities.
And it's based on data, projections, expert views, the whole lot.
Yeah, it pulls together quite a bit.
So, our mission today is simple: cut through the noise, maybe the jargon, and pinpoint the most important takeaways from this report. We want to understand these global economic shifts, their potential impact, and crucially, what's happening specifically in India.
And the goal is for you, the listener, to come away with a much clearer view of the current economic landscape without feeling overloaded, like you've just sat through a lecture.
Definitely not. Okay, let's get into it. The report kicks off by, well, acknowledging some pretty significant headwinds facing the global economy.
It does. The overarching theme is definitely one of real uncertainty and challenges, a lot of challenges in the global environment right now.
And one of the first things it highlights is the huge influence of U.S. tariffs on market movements.
Yes, those tariffs, they've certainly been front and center, haven't they?
They have. So what does the report say we should expect because of them? It sounds like this trade policy uncertainty plus the recent hikes is probably going to slow down global trade and growth.
That's the projection. They even mentioned that some companies are actually delaying capital expenditures, big investments, because they're sort of waiting to see how things shake out.
Holding back on investment, what does that really mean in practical terms? Fewer new factories, maybe? Less tech spending?
Exactly that. It can ripple through the economy. Fewer factories, less spending on new tech, maybe even slower job creation eventually. It's basically businesses feeling hesitant.
Hmm. And the report links this directly to moderating global GDP growth.
It does, and it's not just a minor dip they're forecasting. They put it down to these higher trade barriers mixed with, well, increased geopolitical risks and just general policy uncertainty around the world.
Okay. And are there specific big risks they flag?
Yeah, a few key ones. Things like the global economy becoming more fragmented, breaking into blocks, more trade barriers popping up. And also, central banks might be slower to cut interest rates if inflation stays higher than expected.
Right, the inflation piece. And speaking of central banks, it mentions this divergence. The U.S. Fed pausing rate cuts while Japan is actually raising rates. That seems quite significant.
It really highlights how different regions are facing different pressures, doesn't it? Inflation, growth, jobs. Each central bank is playing its own hand based on local conditions.
Hmm.
It adds another layer of complexity.
For sure. But let's circle back to that U.S. trade policy uncertainty. The report seems to really stress this. Using an EPU index?
Yeah, the Economic Policy Uncertainty Index, it's a way to measure that nervousness. And what's striking is this surge in what they call U.S. Liberation Day tariffs to levels not seen in a
Not
century.
century. Wow.
Yeah, we're talking levels potentially higher than things like the Smoot-Hawley tariffs back in the 1930s, which, didn't exactly help the Great Depression.
Okay, putting it in that historical context.
Yeah.
That really hammers home the scale, and it's not just the initial shock, is it? The report says even after some easing, the effective rates on Asian goods are still way higher.
Precisely. The changes stick around, even after the headlines fade. And we're seeing market reactions already. The report links these tensions to the drop in the U.S. stock market.
Right, they mentioned weaker leverage, maybe companies being more cautious with debt.
Could be. And also that spike in the U.S. 10-year bond yield. Investors are clearly reacting to all this trade tension. It shows how quickly policy noise turns into market moves.
It definitely paints a picture of market sensitivity. The report also touches on the specifics of the U.S. presidency's approach, doesn't it? Like pragmatism versus rigidity on tariffs.
Yeah, there's uncertainty there. Will it be more flexible, or will there be a continued hard line? They even mention potential future tariffs on things like pharmaceuticals.
Which would have massive implications globally.
Absolutely. And then there's this slightly odd situation, a 90-day pause on some tariffs, but maybe a base 10% tariff staying. It's
Yeah.
complex and still unfolding.
So it's a real push and pull, these trade policy risks versus maybe some potential pro-growth factors from the administration like deregulation or tax cuts.
Exactly. The report mentions those potential counterbalances. Pro-business policies, deregulation, maybe tax cuts down the line. It's not all one-way traffic, but the uncertainty is the dominant theme.
And that seems reflected in sentiment, too. Business and consumer confidence up, then down again.
Yeah, that volatility in sentiment really underscores how hard it is to predict the near-term path. It's quite a tangled web globally.
Okay, so that sets the global scene. A bit sobering. Let's shift focus now to India. The report suggests India might actually be in an interesting spot amidst all this friction.
That's right. It flags India as a potential beneficiary of this China plus one trend.
Ah, yes, the supply chain diversification idea. Companies looking beyond just China.
Exactly. India could become a more attractive alternative for manufacturing, for exports, as companies hedge their bets.
Does the report give any clues about which sectors might benefit most?
It does, actually. It breaks down India's top exports to the U.S. So you've got, let me see, pharmaceuticals leading at about 13.5%, then electronic goods close behind at 12.8%, textiles at 12.1%, gems and jewelry around 9%.
Okay, so those are the areas with a strong existing foothold that could potentially grow further with this shift.
That seems to be the implication. What's interesting, though, is that even with this potential upside, the report does show GDP growth projections for India itself being lowered slightly.
Oh, really? So India isn't completely immune.
No, it seems not. It references RBI estimates, that's the Reserve Bank of India, starting from Q1 of fiscal 26. The trend shown is still positive growth year on year, but, well, moderating a bit. Global headwinds are still having an impact.
Right. So potential gains from China, +1, but still feeling the global slowdown. But the report still positions India relatively strongly compared to others.
Yes, that's a key point. Despite the lowered projections and global tensions, when you look at the forecast for 2024, 2025, 2026, India still seems better positioned compared to, say, the US, the Euro area, or China. The growth numbers suggest more resilience there.
So domestic factors must be providing some kind of buffer.
It seems so. Domestic demand, maybe other internal growth drivers. But there's a domestic risk flag, too. The central government potentially missing its FY25 CapEx target.
CapEx. That's government spending on infrastructure, right? Why might they miss it? Revenue pressure.
That's what the report suggests. Revenue pressure could lead to belt tightening on those long-term investments. It even shows the required versus spent amounts towards the end of the last fiscal year and mentions CapEx was up on Jan but down in Feb. Been a bit jumpy.
And if the government pulls back on infrastructure spending, what's the knock-on effect?
Well, it could slow down development, impact-related industries like construction, materials. And the report also reckons this general global uncertainty is likely to dampen private capex in India, too. Businesses might just be more cautious about big investments right now.
Makes sense. Okay, but moving to some brighter spots, the rupee and forex reserves.
Yeah, some positive news there. The rupee has actually strengthened a bit against the dollar recently, and India's foreign exchange reserves have climbed to a pretty hefty $665 billion as of late March 2025.
That's a solid cushion, isn't it? Provides stability.
Definitely acts as a buffer against global volatility. The report also notes moderate pressure on the external accounts. The current account deficit has eased, helped by softer oil prices.
Oil prices. Always a big factor for India. Does it quantify the saving?
It does. It estimates about 20 or 900 crore, which is roughly, $350 million, saved for every $1 drop in oil prices.
Right.
Quite significant.
It adds up. What about the banking sector?
Yeah.
Liquidity.
Seems to have improved. That tightness in funding has eased thanks to various liquidity measures, about 6.9 lakh crore injected, close to $83 billion.
And that should help credit growth for businesses and consumers.
That's the expectation. Better liquidity supports lending. And importantly, the banks themselves look healthy. NPAs, non-performing assets or bad loans, are apparently at a record low, around 2.6%. And credit growth seems stable.
So a solid financial foundation. Anything else on the demand side? Rural economy?
Yeah, some positive signals there. An uptick in rural demand. They mentioned double-digit growth in tractor and scooter sales. And FMCG growth, everyday goods recovering, apparently fueled by rural areas.
Interesting. So rural demand is outpacing urban demand.
The chart suggests that's been the trend in recent quarters, yeah. Rural showing stronger momentum.
And any other early signs of recovery?
A few things mentioned. Traffic at major ports grew in March 25. GST collections remain robust. Power consumption, cement production also showed decent growth in Feb-March 25. These suggest activity is picking up on the ground.
Okay. And corporate balance sheets are strong too.
Generally speaking, yes. The report notes corporate financial health remains strong overall in India.
Right. So quite a mixed picture for India then. Global headwinds, some domestic questions around capex, but also these underlying strengths, strong banks, forex reserves, potential rural boost, China plus one.
And don't forget those long-term structural themes the report touches on briefly. Things like consumer borrowing picking up, financialization, demographics, companies paying down debt, digitization, infrastructure push. All that stuff is still in the background, shaping the longer-term story.
True, those are the bigger, slower moving trends. Okay, let's talk valuation and outlook for the Indian market specifically. How have markets reacted recently?
Well, the report notes a bit of a recovery after that tariff pause we discussed earlier, but also points out the market did come off its peak from September 2024 across large, mid, and small caps. So there was some softening before this recent bounce.
And what about valuations now? Are things looking expensive, cheap?
It's a bit divided, apparently. Large cap valuations have moderated, come down from their peaks, but small and mid cap valuations, they're still trading higher than their long-term historical averages.
So SMIs still look a bit stretched relative to history. That's important for investors.
Definitely. And another thing, earnings estimates for Indian companies for FY25, they've actually been cut. If you compare the March 2025's estimates to back in August 2024, the optimism's been dialed back a bit.
Okay, so lower earnings expectations. But what about money flows? Who's buying?
Good question. The report highlights the supportive role of domestic institutional investors, DIIs, Indian mutual funds, insurance companies. Their flows in calendar year 2025 have been pretty strong, providing support, especially compared to foreign institutional investors, FIIs, whose flows have been more volatile.
Right, so domestic money is cushioning things. Okay, so pulling this all together, what's the report's overall outlook for India?
It suggests growth slowed in 2024, mainly because of less government capex and weaker urban consumption. The current market situation, they see it as reflecting a temporary cyclical slowdown, something that's hitting corporate earnings and valuations right now.
Temporary. So they see it as a blip in the longer-term growth story.
That seems to be the view. But there's a but.
What's the but?
Earnings risk. They mentioned the potential for further downgrades to earnings projections, particularly looking ahead to FY26. So while the current slowdown might be cyclical, future earnings growth isn't guaranteed. That needs watching.
Got it. And valuations again.
They reiterate that large caps look relatively more attractive now, while mid and small caps are still above their long-term averages. And the big caveat is the uncertainty in the business climate. That could delay the hoped-for recovery in private capex.
Which could lead to more market volatility in the near term.
Exactly. So the overall sentiment in the report is cautious for the near term, for both global and domestic markets.
Okay, that's a really comprehensive picture. Thanks. Now, just quickly, the report mentioned the Franklin India Equity Investment Philosophy. Can we briefly touch on their core ideas?
Sure. The report summarizes it as being built on a few key things. A long-term view, using consistent institutionalized processes, a real focus on the quality of businesses, and aiming for GARP growth at a reasonable price.
Tier key, right.
Yeah. And they use a bottom-up approach, analyzing individual companies using a framework they call QGSV.
QGSV, what's that stand for?
Quality, growth, sustainability, and valuation. So under each of those, they look at stuff like management quality, business strength, earnings predictability, competitive advantages, and then, of course, valuation metrics to see if the price makes sense.
Okay, a structured approach to finding quality growth without overpaying.
That's the idea. The report lists some of their funds, too, like the Blue Chip Fund or the FlexiCap Fund, highlighting different strategies for different investors. But crucially, it also includes the standard disclaimer. Mutual funds involve market risks. Always read the offer documents carefully.
Standard but important disclaimer. Okay, so let's try and synthesize this. Bringing it all together from the report, what are the absolute key global economic trends sticking out for you?
Definitely the heightened uncertainty, mostly driven by U.S. tariffs and trade policy in general. That's leading to expectations of, slower global growth. And then you have that divergence in central bank policies adding another layer of complexity. It's a tricky global backdrop.
And drilling down into India specifically, key takeaways.
India has this potential China +1 opportunity, but it's happening while its own growth projections are being slightly trimmed, though it still looks relatively resilient compared to others. Domestically, it's mixed. Potential government capex shortfall is a worry, but you've got stronger rural demand, healthy banks, good forex reserves providing some support. So the near-term outlook is cautious, even with some solid fundamentals.
It really feels like navigating these times requires understanding all these different forces pushing and pulling, doesn't it? Globally and locally. This FT report definitely gives a valuable perspective on those dynamics.
It absolutely does. And, while this deep dive gives you our take based on this report, it's crucial to remember it's just one source, one perspective. We really encourage you to think about how these big global trends and the specific Indian situation might affect your own interests, your own field.
Yeah, definitely. Keep seeking out different viewpoints, different information sources to build your own informed picture.
Exactly. And perhaps think about some of the questions we've raised today. Even without the report, you could research some of the indicators we mentioned, like that EPU index, or look into the trends in specific sectors in India. Keep exploring.
Good advice. Well, thanks for taking this deep dive with us today.